Value trap stocks will wipe you out, pulling you in to invest more money as the stock falls until you lose your entire portfolio. Hey Bowtie Nation, Joseph Hogue here with possibly the biggest risk to your investments. A value trap is a stock that, while it looks like a great price, just keeps on falling. A lot of these are companies with negative news or missed earnings reports, and after that big initial drop, the valuation measures look too good to pass up. And an example of this will show you just how dangerous these are. Shares of AT&T peaked around $32 each early in 2016, but then started falling fast after it announced an $85 billion deal to acquire Time Warner. And you can see here in the historical valuations of the stock, shares at this point were trading for a price of just 18 times earnings. That was less than half the 38 times multiple the stock had reached just a year before, and it typically traded in the 20s or higher on a PE basis. Even better, the shares were still paying a $1.92 per share annual dividend, a yield of almost 11% for investors patient enough to wait for that stock price to rebound. It seemed like a no-brainer. Shares did bounce back 18% later that year, but only to continue a years-long drop on poor earnings and ended up cutting the dividend in half last year. The stock is still at $14 each, 7 years, and it's still down 56% from that high. And the real danger here is that investors see that stock continue to fall, push more money into it to lower their average cost. The thinking goes, if you bought one share at $100 and it falls to $75 each, then you need a 33% gain in the shares just to get your money back. But if you buy another share at $75, your average cost for the two shares is just $87, and you only need a 16% bounce to break even. So investors keep pushing money into that stock, buying in at each lower price until they have so much in the stock, upwards of 20, 30, and 40% of their money or more, and it never recovers. They've sat for years on a dead stock, lost tens of thousands of dollars, and finally just sell out in despair. And next, I'll show you how to spot these value traps before you invest, but finding the best stocks goes way beyond avoiding the worst investments. That's why I created this quick 5-minute guide to finding the stocks that will make you money. Look for the link in the video description below, click through, and you'll get everything you need to analyze a stock in less than 5 minutes. It's totally free, just something I wanted to do for all you out there in the community to help you get started, so look for that link below. Now, spotting a value trap before you invest can be very difficult, especially if you get it in your head that this is a good company. Nation, you have got to stay unemotional with your investments. Invest with your head, not with your heart. The problem here is investors fall in love with a company and lose the ability to see that other side of the story. They get confirmation bias, or they only look for articles or analysis that confirms their view, and anything contrary is just minimized or even ignored. That's why the very best thing you can do when looking at these potential value trap stocks is really try understanding why the bears are selling. What is driving this stock price lower? Is it a long-term shift in customers, competition from new technology, or regulatory pressures? Is it a problem the entire industry is facing, or just bad management at that one company? Answering these first and understanding why investors are selling the stock is going to help you understand if the company can turn around within a year or two, or if it's just dead in the water. From there, you want to look at the company's finances to make sure it can survive while it tries to fix these problems. First, you're looking at the balance sheet here, and you want to see that the company has the cash to survive. More cash than non-current liabilities or long-term debt is a good sign, but optimally, you want to see current assets. Those assets like cash, inventories that can be quickly converted to cash. You want to see this higher than current liabilities, which are the debt the company has to pay within a year. You also want to make sure that the company doesn't need to refinance any big portions of its debt within the next year or two. You can find that debt maturity schedule in the company's 10K annual report. And hey, I know this is a hell of a lot more work than just clicking through to some YouTube video and letting someone tell you which stocks to buy, but how do you know they did the work? Folks, do not let your YouTubers pick your stocks for you. It is not a good investing strategy. Understand how to do this. Spend 10 minutes looking at the financial statements for your stocks, and you'll not only be a better investor, you're also going to make a lot more money by avoiding these value traps and the worst investments. Now from here, you'll want to look at the cash flow statement and focus on these two lines. Operational cash flow is the cash generated from that core part of the business. So obviously we want to see the company generating positive cash flows here. This free cash flow, that's the operating cash flow minus capital investment, the expenses needed just to keep the company operating, and that gets buried in this investing cash flow line. We want to see this number positive as well because it means the company is generating enough cash from operations to cover at least the necessary capital spending. Now, there is a lot more analysis you can do, but just these ideas, looking honestly at a company's problems, and then a quick rundown of the financial statements, that's going to help you avoid 90% of the value trap stocks out there. Now, putting this into practice, I want to show you two examples. One, a value trap that ended in bankruptcy, and another that has produced a 48% return in my portfolio over the last year. Shares of Peabody Energy, the nation's largest coal company, had been falling like a rock since 2011. The boom in shale drilling had driven natural gas prices lower to compete with coal, which was seeing its price plummet. Still, coal accounted for 40% of electricity generation in 2015, and investors rushed into shares of Peabody at what appeared to be bargain basement prices. Now, the problem here was Peabody just didn't have the financial resources to wait out those tightening government regulations on coal and a bad price environment. It had just $261 million in cash and $1.4 billion in current assets, but not nearly enough to cover the $7.4 billion in current liabilities, much of those maturities from long-term debt. The company was hemorrhaging cash, barely free cash flow positive in 2014, and then posting negative $300 million in free cash flow in the next 2 years. It ended up in bankruptcy and wiped investors out. Now contrast that value trap with a stock that I've been talking about over the last year. People said I was crazy investing in shares of WW, the old Weight Watchers, last year after a multi-year plunge in what appeared to be a value trap. That investment has become a 48% return in less than 10 months when the company announced a business change earlier this year. I saw a strong brand name that still had value and financials that could help the company survive through a turnaround. The company's balance sheet wasn't pristine, with $1.5 billion in long-term debt, but it did have $178 million in cash and current assets, well above the current liabilities that it owed. Operating and free cash flow were both positive, even in the worst of times, and the company had cleared its significant debt maturities for the next 2 years. So all this came together to give the company crucial time and financial flexibility it needed to find a business model transition that boosted its shares more than 166% from this year's lows. That's what you need to focus on to avoid those value trap stocks, cash flow and debt, and whether the company is going to have the time it needs to survive. I'll reveal how to sell your value trap stocks without losing money next. But first, I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, the problem with value trap stocks is they can be so attractive, and even knowing what to look for, there's still a good chance you could fall for one. When in doubt about a stock, though, the best decision is just not to invest. Folks, I know it's easy to look at a stock that's fallen so far, to look at the fair value estimates and get dollar signs in your eyes thinking you can make a lot of money on a quick bounce. But you don't need to jump at every stock opportunity that comes along. The very best investing advice I ever got, and this was while I was working as a venture capital analyst, where the bad calls can cost millions of dollars, but the advice was make money on your high confidence investments and avoid all the maybes and marginal bets that will lose your money. Do that consistently, only investing in the stocks you know you can count on and avoiding all the rest, and you will make money. But I know there's going to be value stocks you want to buy and that you're still not 100% confident they're going to stop falling. So I want to give you one more strategy here before I show you how to sell out of your value trap stocks. Now, we've talked about the covered call strategy on the channel before. It's a great way not only to collect instant cash premiums, but also to protect yourself from some of the downside risk. I'll show you in an example next, but this is where you buy shares of a stock and at the same time sell call options against those shares. That gives another investor the right to buy them at a certain price. Now, selling those call options means you collect a cash premium now, money that goes to reduce the investment you put into that stock and lowers your risk in case it falls. I use that covered call strategy often in these potential value trap stocks, especially if I'm buying after a big drop in the share price. That higher volatility after a price drop means I can collect a big premium on those call options for a better downside protection. Case in point here, I've been buying shares of Teva Pharmaceuticals, ticker TEVA, since 2019, just after that opioid litigation and other troubles hit the stock. I started buying at just under $8 a share, but was worried that the stock could still fall further. So to protect my downside and collect that cash return, each year I've sold call options against some of the position at strike prices around $12 and $15 a share. You see, right now I've got 12,000 shares covered with these January 2024 call options below, and I've made $3,900 on those. In fact, I've made over $19,000 in call premiums over the last 4 years, waiting for those shares to rebound. But there were times when it did appear to be a value trap. The shares fell below $6 each shortly after starting that position and have touched that point 3 other times since. So I'm glad I hedged my risk with those call options. Now, that covered call strategy is so powerful for protecting your portfolio and producing a cash return, but I know it can be confusing at first. Check out the video here for a step-by-step explanation of how to set it up, along with my 5 favorite option strategies for both protection and higher returns. But even with those tips for spotting value trap stocks before you invest, there are going to be the stocks that just don't work out. So I want to share some strategies and ideas for selling your value trap stocks without losing money. Now, don't get me wrong, there are no do-overs in investing. As much as you wish you could just break even and cut your losses, there's no magic wand that is going to erase a bad investment. What I want to show you here is how to minimize your losses and get your money back working for you. First is something I've talked about quite a bit on the channel, the rule of never having more than 5 or 10% of your money in any single stock. And that might not help get your money back in a value trap, but it will sure as hell help minimize the damage. Losing 50% on a stock that is just 10% of your portfolio sucks, but it's only 5% loss on your total money invested. That's something you can always bounce back from. On the other hand, losing 50% of a stock that is 60% of your entire portfolio and you're down, let me see, I believe the technical term is you're screwed. That's the kind of loss that shakes your faith in stocks. Another tip is just to start with smaller amounts when you buy a stock. Let's say you have a $100,000 portfolio and want to put $10,000 into a stock. Start with just $3,000 or $4,000 gives you the room to buy more if the stock falls further without bumping into that 10% rule. So split that amount you want to invest in the stock over maybe 3 times. Invest over the next 3 to 6 months. You'll still get all the benefit of that long-term upside, but we'll be able to dollar cost average into the stock at lower prices if it does keep falling. You can see here, that's what I did with Teva, getting shares for just $6.30 each in 2019 and picking up more several times when the price dipped. Now, that first idea, limiting your total investment, is going to help you with this next tip as well, giving your value stocks time to rebound. It's taken more than 4 years for the shares price of Teva to move higher, and it's still not where I think the fair value can be. A lot of investors said I was crazy to invest in SoFi last year, and at one point, I was down 40% when the stock crashed to under $5 a share. It's now up 98% from that low, and I'm up 20% even after the recent sell-off. Nation, do not get scared out of your stocks. The big drops can bring out the bottom feeders, preying on your distress, hoping that you sell out at a loss. Have the confidence in your stock analysis and invest for the long term. Now, I've talked about using that covered call strategy when you first buy a stock, but you can also use it later to make your money back in a value trap. Understand though, you want to sell your calls at a strike price at or close to where you bought the shares. That's the price you're selling to another investor if the stock rebounds, so you don't want to be locking in the loss. It's a great way to collect some cash on your value stocks while you wait for that recovery and give them time to make money. Get your free 5-minute stock analysis guide with the link below, or click on the video to the right to see my 5 favorite options investing strategy, including that covered call strategy that will protect your money and produce a cash return. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.